Hello and welcome to our ongoing webinar series on farmland. My name is Kate Pierce with the Flattabo team, and we appreciate your interest in this webinar today. I'm going to turn it over to my colleagues Glenn Flattabo and Kristine Flattabo-Dunnick to introduce today's special guest.
Yeah, first of all, thank you, Kate, for all of your work in this webinar. We want to thank everyone for joining us on our continued land webinar series. I couldn't be more pleased, and my sister would agree, to invite our long-standing friend and a person that we've relied on for advice many, many times over our career, Michael Swanson. He's the chief ag economist at Wells Fargo. He's a super gifted man. He's also very fun for us to talk to because he can get his advice and his thoughts down at the core level, kind of key advice for us in the business as well as farmers. Michael, number one, thank you for joining us. Thank you for your insights. It's great to have you with us today.
Well, it's a real pleasure to be back. I mean, I really appreciate you and your sister, of course, and the people that you work with. They are the heart and soul of Minnesota agriculture.
Well, and to that point, Michael, I will say many people have watched our webinars, have commented on the advice and your thoughts and analysis. And so it has not gone unnoticed, your involvement. And today's webinar should be very interesting. I mean, many times we reach out to you independently for your thoughts on the ag market, on the grain market. And we thought it'd be helpful for our viewers to kind of see an updated analysis of where you think things are at. Let me start with our first question, which is probably most top of mind for our viewers today. You know, obviously everyone is interested in what their farm is worth, what's happening in the land market. And when you look at the corn and soybean market, you know, essentially in the last 18 months, since really, you know, the end of 2022, we've seen a pretty significant downward slide in the price of corn and soybeans. But when you look at our core business, you know, Kristine and I have sold many farms in the last month. The farmland market is pretty strong. I mean, it's surprisingly strong. And, you know, tillable land bringing 10,500 or 11,000 or 12,000 just in the last couple of weeks. Are you surprised that the land market has stayed this strong, given that, you know, corn's at $4 and soybeans are in the upper nines? Are you surprised by that?
Not really. Start with the old joke is, stock traders have watches, land investors have time, right? And so what changes the land market is going to be very few transactions. I mean, you and I have talked about this before. Maybe 2% of land gets turned over in a year, right? And then, as you and I have had this conversation before, every transaction is a unique little opera or story with different characters, but kind of the same theme repeated over and over again. So land doesn't get radical run-ups in a short term or radical rundowns in a short term. Now, over a longer period of time, lower grain prices, lower seed prices, and a change in the interest rates will move the land market. But it will stay where it's at for a couple of years at least until people really have a change of mind. So no, I'm not surprised because people are not in the land market for a quarter or for a year. They're in it for a decade or multi-decades or generations. So no, not surprised at all. But at the same time, we shouldn't kid ourselves that the delta, the change, is going to be negative if this persists for the next 2 or 3 years. But how much is the big question?
Interesting. Chris, I'm going to toss it to you. I think you have a question on interest rates.
I do. Michael, thanks again for being with us today. I wanted to ask you about interest rates because we get asked that all the time in our business, both on the selling side and the buying side. But interest rates in the farmland business, of course, they've been a double-edged sword. Yes, it costs more for a farmer or investor to buy farmland, but these interest rates have also created a huge opportunity for selling families. As an example, maybe they were getting a 2% return renting out their $11,000 an acre land for $240 an acre. So our question for you, Michael, both on the buying side and the selling side, what are your thoughts on interest rates and what are you expecting to see with rates in the coming years?
That is a key topic. It's not just farm ground. Everybody I talk to has this question. Well, let's go back and look, say, at the 10-year treasury and inflation over the last, say, 20 years. It's been abnormally low. It's really kind of hard for us to say to ourselves, well, a 4.2% 10-year treasury, which is the benchmark. What investors in farm ground should know is that the 10-year treasury is the benchmark. And that's what they should be watching. So if nothing else from this conversation, remember 10-year treasury is the benchmark. And you're looking, you're saying, well, is 4.2 high, or is it low, or is it just right? And it's really impossible to say for a couple of reasons. First off, the Federal Reserve has distorted the market on purpose. And they've told us they're distorting the market on purpose. Following the great banking crisis of 2008, 2009, the Federal Reserve wanted to give people more incentive to invest money. So they depressed the price of interest rates, which lowers the hurdle rate for buying farm ground, but lowers the hurdle rate for buying stocks as well. Well, the Federal Reserve has said, well, with the kind of inflation we have today, we're going to stop artificially depressing that long-term rate. That's a big change. So what does it really mean? It's like, well, stay attuned, but we're probably not going back to a 2% 10-year treasury, which means that borrowing for farm ground is not going back to where it was for a long stretch of time that we all became accustomed to. So it's really, we're at a moment of change in the interest rate markets that we haven't seen in 10 or 15 years. And so you bring it up well. And so what families need to say is, well, where do I feel more comfortable? But the long and short of it is, we are not going back to the ultra cheap interest rates that we had. I'll give you an example. During the peak of the COVID intervention, we had the 10-year treasury at 0.5. That is incredibly cheap money. And that meant it was incredibly cheap to borrow money. And so you could go out and pay a bigger multiple for that farm ground to buy it. Well, that's not going to be the next transaction. Today, if you go out and buy, and probably for the next 2 or 3 years, it's going to be around that 4% 10-year treasury, maybe plus or minus 30, 40 basis points. That's what you need to say, where do I want my money and why do I want it there? But this is a much more new normal. And we're not going back to that ultra low interest rates for a lot of reasons.
Well, and I want to have one follow up with that. I mean, we've seen it firsthand in our business. So much of the trigger for us when we're hired to sell a farm is usually the passing of parents, or the grandma passed away. The farm has been in the family 100 years. She was 90. Now the kids are in their 60s, but they can't own it in the next generation with, 18 grandchildren. But 5 years ago, families would say to us, what do we do with the money? I mean, that they didn't have a vehicle or a transition to, put the money in a money market or something. And that has now changed. And so for some of these families, to Chris's point, the 2% rate of return on $11,000 ground, and they look at a 4% rate of return in a different area, has become attractive. And it has changed our business. And it's interesting to hear your thoughts on kind of how that you think will stay in probably a more similar place in the future as it is today. Is that right, Michael?
I would agree. Yeah, I know a couple things we're going to add to that as well is the tax situation changes as well. We know that the estate taxes right now are very favorable for passing larger amounts of money through at the federal level, at least. Minnesota doesn't seem to be all that aggressive at bringing up their estate exemptions. So there's things like that. There's a tax treatment. Your farm rent is active income, so it's ordinary income. If you put it into the stock market, it was a dividend, you get a more favorable treatment. So the world's really changed from 5 years ago. And I think you're exactly right, Kristine and Glenn, that people are saying, okay, that was yesterday's opportunity. What's today's opportunity? And the land market's going to have to make an adjustment to it. And definitely going forward, it has a higher hurdle rate. It's going to be a lot more tougher to get over that hurdle rate if you're not an active farmer.
Yeah. I want to talk to you about the grain prices, what you see in the next couple of years, or you're predicting with grain prices. You and I have had a number of conversations privately about, our relationship with China has changed, and China's buying more of their grain from South America. I think China's population aging and some of those factors. But the supply and the demand, we just don't have, it seems like, the global demand for our products. Walk our viewers through what you expect to see in the grain markets in the next couple of years, specifically with corn and soybeans, if you wouldn't mind.
Yeah, I think the $7 corn, pick a number out of the air, was the aberration, not the $4 corn. Now they don't want to hear that if you're a farmer. And my nephew and my cousins don't always like me in their machine shop. And so I'll just put that out there. But when you look at the last 10 or 15 years, and you look at where the prices have been more often, you say, which is the aberration? It's hard to say that the $4 corn is the aberration. So why would that be? A couple of things. Declining global population growth rates. Food demand starts with people, and it's always going to start with people. And where we see strong population growth still, something north of 2, which is extraordinary in today's world, it's usually in less developed countries of lower incomes. And we're not their best source for food because we're a high cost producer because of labor, taxes, transportation. So that demand growth has slowed and will continue to slow. China is negative. 20 years ago, when we were talking, China was not a negative population growth market. India is slowing dramatically over time. So starts with people and the growth rate. We're not shrinking globally, but the growth rate is slow dramatically. You also look at the Brazils, the Argentines of the world, the former Soviet Union areas of the world. There's a lot of ground that's not in production, could be in production at a price point. And so the balance is, hey, $4 corn keeps the market more in balance than $7 corn does. And so I think when we think about that slowing population growth, record per capita supply of grains and oilseeds in the world today, and relying on biofuels to continue to grow, there's a lot of things that you should be, kind of more muted on as a pro high price person on a go forward basis.
Very interesting. Aside from land values and what land is worth, the second largest or greatest question we get asked is cash rents. And Kristine and our company is not in the business of doing that as a service, but I know Kristine has a question on where you think cash rents will be at, because that's the big factor, of course, for landowners. Go ahead, Kristine.
Michael, given the general bearish picture of the grain markets, and you're well aware of the prices that corn and soybeans need to be at for the average farmer to be profitable, are you expecting to see a downward slide of cash rental rates paid to landowners in the coming years?
That's a great question. And let's walk through and change the question from the dollar amount, which is very arbitrary, very, let's talk about what share of the corn yield and the soybean yield can go to cash rent while leaving enough for everything else, including the renters' profitability and living expenses. So when you think about it, we can go to the Minnesota Farm Management Database and we can take the cash rent that was paid in Minnesota on average versus the average revenue in that piece of ground. And we can convert it into how many bushels of corn was it, how many bushels of soybeans was it, versus how many bushels of yield did you get. So what's changing over time? There's a couple things changing over time. One is we expect more yield, which is great for the landowner because they're going to get a share of that growing yield. But when you look where we're at right now, we're not actually too far off historical averages for the share of yield that's going to cash rent. Where we were very, very far off of historical norms was the fertilizer component. If you look at the 2023 numbers, which have come out a long time ago, and we'll see the 2024 here in March, 25% of cash rent in corn, or 25% of the yield in corn went to fertilizer. Typically, that's about 17%. So the good news here, and I'm not just being I'm seldom Mr. Sunshine, is that we're going to see a lot of that fertilizer expense roll back into cash rent and roll back into living expenses and profitability. I expect that NPK component to have to go back to its long-term norm. So if there's anything that's going to support cash rents over the next 2 or 3 years, is that they're not going to have that heavy burden, that extraordinary burden of NPK costs that we saw in 2023 and 2024. So that's actually a pretty good positive. So going out over 2 or 3 years is about as far as I want to go for a forecast. I think we're going to see a trade. We're going to see that cost come out of the NPK and go back towards the operator and the landlord.
So in short, I mean, essentially, if that's true, it should stabilize or put basically a floor on the rental rates, even if these prices stay the same, is what you're looking at.
Yes, that's what I'm saying, is that don't expect any increases. Yeah. So let's say they take $150 out of the per acre cost of fertilizer. Yeah. Well, there's a lot of hungry pockets out there that need it. It could be the seed, it could be the crop chemical, it could be the machinery, it could be the landlord, and it could be the operator. So It's not like it's all going to just run towards cash rent, but it's a very good thing not to have that NPK hanging up at that 25, 26% rate of yield.
Mm-hmm. Super interesting. The next question, and this has been fascinating for Kristine and I, as you know, and many viewers do, our dad started this business in 1978. We grew up on a farm in Candido County, just north of Welmer. And, John Deere 4020 tractor was our biggest tractor in 1980 and, all of the above. But when we look at the difference, one thing that's really changed in our world is renewable conversations. I mean, we were never having these conversations 20 years ago. Once a week now, we're getting a call. Just on Monday, I had a call on a family looking at a solar project in Renville County for their farm. I had a call last week on a wind project in Meeker County, and landowners are looking at how do they assign value to this. The renewable energy discussion of flying airplanes with soy products. One of the brightest folks that I know in the ag sector, said to me, it's all about on renewables. I want you to walk through with our viewers kind of your thoughts on renewables. And if you would, I mean, look into the future 10 years and say, will we look back at this webinar in 2034 and say, God, renewables really changed the market in the past 10 years? Walk us through your thoughts on renewables and how that's going to affect the grain markets.
That's a great question. And it's countrywide. I get this in California. I get this in North Carolina as well. And there's a lot of emotion around it as well, because a lot of people don't like to see good farm ground go into solar panels because it's like, well, it'll never come back out. But we might be, I'm going to put this kind of towards peak renewables right now, policy-wise, in the sense that we do know there's other alternatives, that could happen out there. For example, nuclear is another competitive source of electricity, and suddenly it's seeing a resurgence on a policy front, and we can put in how many megawatts of nuclear. So right now, it's extremely positive for renewables. The Biden administration has been very pro renewables on an ongoing basis. Now, I don't think it's going to go away. That's that scallywag Ronald Reagan used to say the closest thing to immortality is a government program. And so when you think about that, the programs that are in place will probably stay in place. And 10 years, 15 years are probably there to stay. But will the same growth rate be there 2 years from now, 4 years from now? And the answer is probably not. I would see, maybe the Trump administration saying, yeah, I like that nuclear stuff, smaller footprint, we have modernized technology around it. The AI buyers who want tons of electricity seem to like it because it's dependable. We won't see renewables go away, but will we see the same growth? And the answer is, I don't think so. And so if you're in it, you're probably fine. If you're betting on the come 5 or 10 years down the road to see even more of it, I would be a little bit more skeptical than that. Because there are alternatives out there for everything. And there are substitutes. Even let's take ethanol, which is the mainstay of the corn consumption. Electric vehicles. If we do see better electric vehicles, ethanol demand will also suffer for that. So 5, 10, 15 years, yeah, I think we're pretty much at peak renewables right now, because I think we're seeing policy shifts that are going to be promoting other alternatives on a long-term basis.
Super interesting. The next question Kristine has is about basically, some of the federal public policy initiatives, crop insurance, and the supports that they have. Chris, why don't you walk through that question?
Michael, here's how I worded this question, but you're the expert, not me, but I'm going to put this in Glenn and I's words here. We think what seems to have changed in ag significantly over the last 30 years, Glenn and I have been in the business now around 30 years, is the risk seems far less today than in the past because of the Farm Bill, crop insurance, and general ag policy or food security. In short, because of the support of the federal government, are the lows less low today, or are they nearly guaranteed to get close to breaking even on the bad years?
Absolutely. And it's interesting. Let's do a little history. We were in trouble with the WTO as a country, World Trade Organization, because we were putting excessive amounts of direct payments into farming. And so what we saw was crop insurance was considered red box. Direct payments for production was considered red box and still is. So we said, well, let's build the crop insurance component, which is not green box, but it'd be amber box. So it's kind of like, yeah, we don't know what it is, but it's not red box. So you don't get penalized for it. Okay. So we've built crop insurance over the last 20, 25 years. And it made a big impact. It exactly talks to what you're talking about. If I know going into March, what's my minimum amount of money I can get, say the entire crop gets wiped out, say the price of corn goes to zero, I still know how much money I'm going to make. So when I want to bid cash rent, which is a big part of our theme today, is, well, how much cash rent can I really bid without exactly bankrupting myself? So we saw share rents literally disappear. I mean, I was in Indiana years ago and Illinois, and people just say, yeah, who wants to do share rent? Who wants to have to rely on their renter to tell them the real yield on that piece of ground and get it right versus just saying a check, how much of a check am I going to get? And why could we go away from share rent to cash rent is because we had that dollar amount set in stone through the crop insurance program. So yes, you're exactly right. We have eliminated that really downward, get wiped out type year in agriculture today. And the knock-on effect, as we would say, is we went to cash rents and we're like, okay, let's just keep it simple. Here's your check. We'll see you again next year. And so we've taken out that, but most of the benefit did not accrue to the operator. It accrued to the landowner. And that's not unnoticed in the policy world. They know that the landowners have accrued a lot of the benefit from crop insurance because it goes into cash rent. It's interesting. Go back to the Minnesota Farm Management Database and you pull up grain operators. When you get to the 5,000 to 10,000 acre operation size, they don't have a ton of people in that bucket in their database. 85% of the ground they're operating on is rented, cash rented. Those are the big hitters. Those are the guys and gals that are renting your ground that are making the land market work. And they can only do that because they are incredible users of crop insurance. They write some big checks. But on the great scheme of things, it's the biggest subsidy they get in terms of risk avoidance. So yes, you're exactly right. As long as the crop insurance program stays the same, we can avoid wipeouts, and that accrues to the landowner's benefit.
Thank you.
Just fascinating, Michael. Before we conclude today's webinar, anything else that we should be asking you? Anything top of mind that you're seeing in all of your circles or travels, Michael?
You know, tariffs right now are an issue, and they're kind of implicit in everything. And so a lot of people are working through the numbers. How much do we export of this? How much do we import of that? Who do we export it to? So we could see some turbulence here, if we really do get into a tariff dispute, which will probably be a temporary thing because it's not beneficial for either side. But I think we could see some turbulence around tariffs because take Mexico. Mexico is one of the primary grain and oilseed export market that we have on an ongoing basis. If they do apply a retaliatory tariff, can they go to Brazil and Argentina to get the grains and oilseeds they need cheaper? Will the logistics work out for them? There's a lot of issues going on right now. So tariffs is one. It's going to be a short-term irritant, not really a reason to buy or sell ground on a generational basis. But I think in the discussions with cash renters today, it would be something that would come up and might be well worth reading a diversity of sources on to see what might happen.
Yeah. Before we conclude the webinar today, Michael, I do want to just share a personal thank you to you from not just us, but from the families that watch these webinars. And, many of these families, and Michael, you and I have spoken about this many times, people are watching them. They own the family farm. They're relying on the cash rent for retirement incomes or to send their kids to college. They're trying to make a huge decision on when they sell the family farm. And it isn't just your advice and your thoughts that have led to an interesting conversation. I mean, a lot of people are making big decisions based on, information that they're gathering from these webinars. And we've heard so many families say to us, we've appreciated the time that Michael Swanson's given us and your firm with these conversations because it's a big deal. Like when Kristine and I are hired to sell the family farm, to a lot of people, it's the biggest transaction of their life. It's life changing, whether to their kids or to their personal situation. And I want you to know, on behalf of both of us and our viewers, we really have appreciated the time that you've given us.
Well, yeah, and it is a important transaction, and I will appreciate that. So let's just offer out to people that if you want to have more questions or follow up, reach out to Glenn, and I will do my best to answer as clearly as possible.
Kristine, any parting words before we have Kate put up the last slide?
Thank you, Michael. We're grateful for your time, and there's 100 more questions that we could ask you today. Really appreciate who you are and all that you've shared today. It means a lot.
And to our viewers out there, and Kate, I'll have you put the final slide up in just a moment. If anyone has any questions, you're obviously welcome to reach out to Kristine and I anytime, even if it's not about selling your farm or just general questions. We're happy to either give you our thoughts or put you in touch with the right expert. On behalf of all of us, Michael Swanson, Kristine, myself, our team, we certainly appreciate your time. Kate, I'll have you put up the final slide and we'll conclude our webinar. So here's our list of our services. Of course, our contact information is below. You can also go to Flattable Land to see our upcoming auctions or additional webinar videos. Again, thank you, everyone. We will see you on the next webinar.